Bismillahirrahmanirrahim. Today we are going to start the next chapter that relates to week 2 and week 3. That is financial statement analysis. First thing is, what are financial statements? Financial statements are written financial reports that quantify the financial strength, performance, and liquidity of a company. These are basically reports, and these reports shows financial strength, that company is financially strong or financially weak. Financial performance means the profit or loss, and liquidity of a company, whether the company can pay its debts on time or not. They represent a formal record of the financial activities of an entity. Financial statement shows the financial activities of an organization. These financial statements reflect the financial effects of business transactions and events on the entity. And what is the purpose of these financial statements? These financial statements shows the effect of these different business transactions and events on the entity. That what is the impact of these different transactions on the organization. They are useful for the following reason. The first one is to determine the ability of a business to generate cash. They're telling us about the ability of a business, that the business can generate cash, and the sources and uses of that cash, and what is the source of that cash and what are the uses of those cash. That cash flow simply. So it tells us about how the business is generating cash. It is telling us about the ability of a business to generate cash, and it tells us about the sources of that cash and the uses of that cash. The second is to determine whether a business has capability to pay back its debts. The second use of the financial statement is that it tells us the ability, the capability of a business. Can the business pay back its debts? They can pay their liabilities or not. To track financial results on a trend line to spot any looming profitability issues. They're giving us information that if the possibility that if there can be any problem in the future profitabilities, it is predicting about the future profitability issues. To derive financial ratios from the statements that can indicate the condition of the business. We can get financial ratios, and these financial ratio indicate the condition of the business. Then on the base of these ratios, we are analyzing that what is the condition of the business. The condition is good or the condition is bad. And the last one is to investigate the details of certain business transactions as outlined in the disclosures that accompany the statements. And there are some important events disclosed at the end of these financial statements. we call it disclosure. So it helps us to investigate the details of certain business transactions. The notes, the disclosures at the end of these financial statements, they are helping us, these notes are helping us to investigate the details of certain business transactions. By studying these notes, if something, some important events happened in the business, so these notes are telling us about these important events. So that is another use of these financial statements. So these are different uses of financial statements. Now, what is financial report or what is financial reporting? Financial reporting is the language of communicating the financial information and financial condition of a company or business concern. It can be non-profitable organization and public or private organization. It can be a public organization or it can be a private organization. So what is financial report or what is financial reporting? It is basically the language of communicating financial information and financial condition of a company or business. Just like to communicate something to other, we use language. In business, for communicating the financial information, we are using financial reports or we are using financial reporting. So financial reporting or financial report is basically the language of business in which our aim is to communicate the financial information of the company to the stakeholders. Language has grammar and punctuation. You know about this thing. Whereas financial reporting requires GAAP and IFRS. Just like all other languages, they have grammars and they have punctuation. Same is the case with financial reporting. In financial reporting, we are using generally accepted accounting principles and international financial reporting standards. GAAP, it is basically used in United States, and IFRS used in mostly in UK. So financial reports are basically reports which are used to communicate financial information of the company with the stakeholders. There are different types of financial statement. Now, the financial statements, balance sheet, income statement, cash flow, statement of owner's equity or shareholders' equity, we are using these reports to communicate the financial information. So basically, this is financial reporting. Now, types of financial statements. The four main types of financial statements are: the first one is statement of financial position. Statement of financial position is basically the balance sheet. Also known as balance sheet, presents the financial position of an entity at a given date. It is telling us, this balance sheet is telling us about the financial position of a company at a certain date. Statement of a financial position help users of financial statement to assess the financial soundness of an entity. This balance sheet is helping us in judging the financial soundness of an entity in terms of liquidity risk, in terms of financial risk, in terms of credit risk, and in terms of business risk. You already studied these things in business finance and financial management. I'm not going to repeat these things again. So liquidity risk, financial risk, credit risk, and business risk. It is comprised of the following three elements. Three elements are coming in balance sheet. The first one is assets, something a business owns or controls, cash, inventory, plant and machinery, etc. Anything valuable in the business, we call it assets. Liability is something a business owes to someone, something that we will pay to the outsider, creditors, bank loans, etc. Creditors are those people who gives you loan or who gives you goods on credit. And the third thing that is coming in balance sheet is equity, what the business owes to its owners, the investment of the owners, what the business will pay to the owners. This represents the amount of capital that remains in the business after its assets are used to pay off its outstanding liabilities. Simply, assets is equal to liabilities plus equity. Suppose the total value of asset it is $100,000 and the liabilities are 40,000. Now what is left is this thing. We call it equity. So 1 lakh are the assets. Out of this we will pay 40,000 to the creditors. Remaining what is left, this 60,000, the company will pay this amount to the shareholders or equity holders. Equity therefore represents the difference between the assets and liabilities. So equity E, it is equal to assets minus liabilities. You know about these things, I'm just repeating it. The second statement, it is the income statement, also known as the profit and loss statement, represents the company's financial performance in terms of net profit or loss over a specified period. Income statement tells us about the profit or loss of the business. Income statement is composed of the following two elements: income and expenses. What the business has earned over a period, we call it income. Expenses, the cost incurred by business over a period. You can't say expenses, the cost, you can say that the payments made for generating revenue. We call it expense. Salaries, wages, depreciation, rental charges, etc. These are expenses. Then the result, the difference between these two, income and expense, it will be net profit or loss is arrived by deducting expenses from income. Purpose and use What is the use of income statement? Income statement provides the basic basis for measuring performance of an entity over the course of an accounting period. It is just telling us about the performance of a company over a period of time. Performance can be assured from the income statement in terms of the following. Now, where we are using the income statement, how we are using the income statement, changes in sales revenue over the period and in comparison to industry growth. Like suppose in 2018, what is the profit? This year in 2019, what is the profit? What is the change in these 2 years? There is increase or there is decrease in the profitability. So income statement is telling us about these changes in sales revenues over the period and in comparison to industry growth. And this profit in 2019 as compared to the industry, the whole industry, are good companies in the industry. We can compare it with other industries. The second is changes in gross profit margin. We are using the income statement to see what is the change in the gross profit margin, what is the change in operating profit margin, and what is the change in net profit margin over the period. Like there are different ratios you studied in ratio analysis. One is gross profit margin, one is operating profit margin, gross profit divided by sales, operating profit divided by sales, and then one is net profit margin, net profit divided by sales. So we are using these ratios to see the changes in gross profit margin, operating profit margin, and net profit margin, and on the base of these we are taking some decisions about the future. If there is decrease, so we will try to improve our performance. If there is increase, so we will try to make it more better and better. The third thing is increase or decrease in net profit. What is the increase in net profit? What is the increase in operating profit? And what is the increase in gross profit over the period? We are using the income statement to check these things. Whether there is decrease in net profit, whether there is decrease in net profit or increase in net profit, operating profit and gross profit over the period. Comparison of the entity's profitability with other organizations operating in similar industries or sector. We are using this income statement to compare our profitability with other industries, other companies in the industry, or with the whole industry. Income statement also forms the basis of important financial evaluation of an entity when it is analyzed in conjunction with information contained in other financial statements such as changes in earning per share over the period. This is, if you will study the income statement, at the end of the income statement, we are calculating this thing, earning per share. EPS. Analysis of working capital in comparison to similar income statement elements, and analysis of interest cover and dividend cover ratios. Basically, these are parts of the income statement. We are checking what is the EPS, we are checking what is the working capital position, and we are checking the interest coverage ratio and dividend coverage ratios in income statement. So income statement also forms the basis of important financial evaluation of an entity. We are using the income statement for important financial evaluation of an organization. When it is analyzed in conjunction with information contained in other financial statements. When we are analyzing it in conjunction with information contained in other financial statements. And what are these other financial statements? Changes in earning per share over the period. In income statement, we are also checking this thing, that what is the EPS previous years and what is the EPS this year, earning per share. And we are comparing this EPS with other companies also. Analysis of working capital. We are also analyzing working capital to similar income statements. Example given, the ratio of receivables reported in the balance sheet to the credit sales reported in income statement. That is debtor turnover ratio. So we are using this in working capital comparison. And analysis of interest cover and dividend cover ratio. And we are also checking that how much interest we are covering, interest coverage ratio. EBIT divided by interest. If you people studied it in ratio analysis, coverage ratio. EBIT divided by interest. In this ratio, we are checking that how much, what is the capability of the firm in covering the interest charges. EBIT, earning before interest and taxes, divided by the interest expenses. So here we are checking the capability of the company in covering their interest charges. Can we cover our interest charges or not? Suppose EBIT is suppose 1000, and suppose our interest this year it is 500. So we got 2 to 1. It means if 1 is your interest, you are earning 2 to pay this interest. If it is 3 to 1, it is better. If it is 4 to 1, it is more better. It is 5 to 1, it is more better. So it is showing us about the coverage. Can we cover our interest charges or not? So here 3 to 1 means if $1 is your interest, you are earning $3 to repay this interest. Here, if $1 is your interest, you are earning $4 to repay this interest. Here it shows that if your interest is $1, you are earning $5 to repay this interest. So we are also using these things, these coverage ratios and EPS and working capital comparison in income statement to analyze different things. The next statement, it is the statement of changes in equity. Statement of changes in equity. Statement of changes in equity, also known as statement of retained earnings. It is also called statement of retained earnings. Details the movement in owner's equity over a period. This statement of changes in owner's equity shows if there is an increase in owner's equity or there is a decrease in owner's equity over a period. The movement in owner's equity is derived from the following components. Now suppose at the beginning of this 2019, what is shareholders' equity? And at the end of this 2019, suppose 1 million is the shareholders' equity. Then at the end of 2019, we will see if there is decrease in this shareholders' equity or there is increase in this shareholders' equity. Suppose it goes to 1.5 million. So it shows that there is increase in shareholders' equity. So statement of shareholders' equity are statement of owner's equity in sole business and partnership and shareholders' equity in joint stock companies. We are analyzing whether there is increase in shareholders' equity or there is decrease in shareholders' equity. So this statement of shareholders' equity, it is telling us about the movement in owner's equity over a period of time. The movement in owner's equity is derived from the following components. And this movement in shareholders' equity, it is derived from these 5 components. Net profit or loss during the period as reported in income statement. If there is net profit, that profit will be added to this. We will add this profit to this shareholders' equity. And if there is a loss, so we will deduct this loss from shareholders' equity. So this is the first component that is affecting the shareholders' equity. Share capital issued or repaid during the period. If you issued new capital, you issued new shares, so we will add it here because it will increase the shareholders' equity. But if there is redemption of shares, redemption of shares means buying back the shares from the shareholders. So there will be decrease in shareholders' equity. So see, share capital issued or repaid during the period. Repaid means a redemption of shares. When you repaid the money to shareholders and took the shares from those shareholders. Take an example. There is a person, he has 1000 shares. The price of one share is $10. So what we did, the company, this is company paid the money of $10,000 and took back the shares from these shareholders. This is called redemption. And when we pay the money back to shareholder, our shareholder equity, it will decrease. dividend payments. When the company paid dividends, so our shareholder equity, it will decrease. When you will pay, it is just like drawings dividend. Suppose your owner's equity is 1 lakh. I'm talking about owner's equity in sole business. And we pay the owner, he withdraw some money from the business, that is $1,000 for his personal use. So this will decrease the owner's equity. From 1 lakh, it comes down to 99,000. Same is the case in joint stock companies. 1 lakh is our shareholders' equity. Now the company, what the company did, the company paid $10,000 dividend. You know about dividend, that what is dividend. So when you paid the dividend, your shareholders' equity will come down to 90,000. So this is dividend payments. Number D is gains or losses recognized directly in equity. Gains or losses recognized directly in equity. Revaluation surpluses. What is revaluation? You will study this thing in detail in advanced accounting. So if there is a revaluation, you are revaluating all the assets. So because of that revaluation, suppose sometime if the business, if we want to finish the business, so what will we do? Accountant will come, they will reevaluate the assets, and they will reevaluate the assets. So maybe the value of asset can come down, it can go up. So we call it revaluation. So because of this revaluation, if it comes down, we will deduct shareholders' equity. We will deduct that value from shareholders' equity. And if there is, if the value of these assets goes high, so then we will add that value to shareholders' equity. Effect of changes in accounting policy or correction of accounting error. Sometime there is a change in accounting policy, and because of that, the value of assets can go up or can come down. If it comes down, so we will deduct it from shareholders' equity, and if it goes up, we will add it to shareholders' equity. In the next class, we will discuss about these things in detail. It is here, but I think for today it is enough. So inshallah, in the next class, then we will talk about these components in detail. Okay, have a good time.